Ankit, a lot of people increasingly, especially young people, and not just young people, spoken to people across age groups, tend to feel and believe that, the minute the returns from their mutual funds do not, say, mirror what their expectations are over a short period, they feel they can do it themselves. They can trade themselves. And if you see, even in the last 2, 3 years, the data before us, whether it's the opening of demat accounts, trading accounts, all seems to be pointing in one direction, which is up. You're someone who has the experience of having been an analyst, you're a CFA, and you're now with a mutual fund. How difficult, what would be your word of caution? People think, oh, it's all just about getting on there online. Technology today allows you to do things so easily in the capital markets. And it's all about just going and, buying a few shares and selling them. Can you take our viewers through how difficult it is to pick stocks and what goes into picking a stock when you as a fund manager is actually buying shares?
Right. So I think we're talking about the direct way of investing into equity, which is analyze the share, analyze the company, analyze its financials, analyze how the company's shares are owned in the equity market, and then make your investment call, whether it is to stay away or to invest or invest more in. But remember, there are not only just this direct mode of investing in equity, is what we talked about in the first question, but there is also other modes of investment. Incidentally, I think direct investing in equity is probably the riskiest way. It's probably the highest risk way of getting involved in equity markets. So we'll come back to this question of if there are other ways to invest. But I think coming back to this, to the salient question of how do we invest in a particular stock, or how does one invest directly in a particular stock? It's a multifaceted question. We look at Quant Mutual Fund, we look at multiple ways of analyzing the company. As I said, not just the financials, not just the recent growths and the return ratios, which is being the assets that have to put in to make the company. Not just the basic financials, but also we try to take a look into the structure of the company, who has invested, when they are investing, the timeliness of other investors coming in, new investors coming in, the timeliness of investors wanting to go out, large groups, right? Private equities, who typically have a 5, 7, or 10-year time horizon investment. And then when they go in and out, they change the structure of the company and who owns it. So when you are investing in a company, there is a multifaceted analysis to be done. And both from the long-term perspective as well as short-term perspective, there are many things that can change your investment conviction in a company. To understand how do we invest in the direct fashion, we not only go deep into company financials, but also understanding the company's equity structure and the investor patterns and the behavior. So we love the behavioral analysis part of the investments. And also we try to gauge in the macroeconomic environment, how is the risk appetite of the general investor, which is going to change significantly the way the mass investors go in and out of certain types of stocks. Okay, there are many types of stocks. There are large cap companies, there are mid cap companies, there are small cap companies. So these various buckets of analyses, risk appetite, liquidity analytics, we call it, right? The structure of the company, as well as the fundamentals of the company, we call it the V, or the valuations part. We take them in when we choose to invest in a stock, or this is what you should do as well, or try to do as well. Coming back to one little part that I mentioned earlier, as far as trying to gauge if there are other ways of investing in the equity market, not just the direct way. So I'll just complete this here, and then I'll hand it back to you, Vivek. But there is AIFs, alternate investment funds, There is a PMS, which is a portfolio management services that high net worth individuals can access. And then there are mutual funds, just companies like ours. And I think progressively, as I mentioned these names, the risk goes down. So I would say mutual funds are sort of the least risky way to invest or access equity. And again, this is affirmed by another recent study that there was in Andhra Pradesh University, who said that, even as secondary market investing is only about a choice for about 20% of the mass. But really, when you look at the 40 to 60-year-old age group, which is perhaps your earners and your family investors, these people, or this cohort, the vast majority of them, about more than 60% of them, prefer investing in equity via only mutual funds or secondary markets, as they are called. So that is again something that you should take on board, that as you mature and as your risk profile is maturing, you will probably end up in the secondary markets or the mutual funds, because they kind of take care of your risk from multiple parameters.